Welcome to the deep dive. Today, we're taking a forensic lens to the exploding Indian credit card market. It's growing at a phenomenal pace. I'm Priyanka Chakraborty, and my co host is Anil Agrawal.
Oh, absolutely. It's probably the fastest growing major credit market on the planet right now.
But at the same time, it's operating under this intense microscope of regulatory scrutiny.
It really is a market defined by that contradiction. You know, running at two speeds at once.
At two speeds? How so?
Well, on one hand, you've got this incredible, just unprecedented digital-led expansion. But on the other, you have India's central bank, the RBI, and they are rigorously tightening the guardrails.
And the scale, the numbers are just immense.
They really are.
To set the scene for you, as at November 2025, the total number of active credit cards in circulation has sailed past 110 million.
That's 11 crore cards. Let that sink in.
We are seeing over 15% year-on-year growth in new cards, which so far has pushed annual spending in fiscal year 25 to 21.13 lakh crore.
That's right. And that growth rate, that 15% in both new cards and spending, it just shows you the fundamental appetite for credit in India is massive and largely unmet.
On the one hand, you have big players like HDFC and ICICI leading the growth charge.
On the other hand, there's the regulator stepping in forcefully, right when the market is booming. You know, why make credit more expensive for banks right now?
I think the answer, and we'll unpack this, lies in what is actually fueling that growth. And it's not what you think.
It's all about a big shift towards smaller digital unsecured transactions.
Let's jump into that first big aha moment, the one that really changed the entire landscape.
You're talking about the integration of RuPay credit cards with UPI.
Exactly, the Unified Payments Interface.
Since mid-2022, that link has acted like a turbocharger. It has democratized credit, bringing it into, everyday microtransactions.
Your chai purchase, your metro fare.
Your daily grocery run, all of it.
And this is where the data gets really illuminating. You have to look at this split between volume and value.
This is the critical point.
UPI-linked credit card transactions now account for a staggering 40% of total transaction volume.
40%. And just for context, that's up from only 10% from 2024, a fourfold jump.
It's unprecedented acceleration in volume.
But what about the value?
And that's the catch, that's the critical context. Those 40% of swipes, they only account for about 8% of the total transaction value.
Okay, so that paints a very clear picture for you.
The growth isn't coming from buying a new TV anymore.
Not the marginal growth, no. The incremental growth unit is the high-frequency, low-ticket swipe.
Which totally challenges the traditional banking model, right? The one that relies on people carrying big, high-interest revolving balances.
It does. Banks now have to figure out how to actually make money from this huge volume of tiny digital transactions.
Where the ticket size is much, much lower.
Exactly. It forces an immediate strategic pivot. They can't just count on interest income from big debt balances.
They have to get smart about interchange fees, cross-selling.
And just being incredibly efficient operationally to make those tiny margins add up.
And this whole integration, it's had huge ripple effects, especially for RuPay.
RuPay, by just plugging into India's digital public infrastructure, now commands 38% of all credit card transactions by volume. That's huge.
That is a huge win for a domestic network. It just shows the power of linking credit to UPI's gigantic user base.
It's proof that consumers want digital speed. Contactless and digital now make up 85% of all credit card transactions in India.
Speaking of strategy, there's one acquisition tactic that really stands out for the issuers.
The co-branded credit cards.
Yes, CBCCs. These partnerships seem to be the high-octane engine driving everything.
And it's all about the unit economics. It's why they work so well.
Okay, so co-branded cards only account for what, about 17% of all cards?
Yes.
And 18% of spend?
Roughly, yes. But they deliver drastically better returns. Banks are reporting that CBCCs have about a 60% lower customer acquisition cost.
60%. That's a massive saving, which is why you see them everywhere. The Amazon Pay ICCI card, the Flipkart Access card.
They get to bypass all that expensive marketing by tapping right into a retailer's loyal customer base.
And that loyalty actually translates into real usage.
It does. These cards have a 70% activation rate. Compare that to maybe 50% for a generic bank card.
And customers spend more on them.
About 20% more on average. Yeah. So you're getting better customers cheaper and faster.
But hang on, if you're acquiring customers at a 60% lower cost, it does raise a pretty critical question, doesn't it?
Which is?
Well, given RBI's worries about unsecured lending, aren't you just trading short-term cost savings for potentially higher default risk down the line? If the screening isn't as tight.
And that's the exact tension the RBI is trying to balance. Lenders will argue that the co-brand partnership gives them better data. You know, they see your shopping history, your loyalty.
Which helps them score you better.
They'd say so. But the regulator sees the systemic risk of rapid, low-security digital onboarding, and they've acted to put the brakes on it.
And wait for it. In terms of geography, the story isn't just in the big cities anymore.
No. Although while the Tier 1 metros like Mumbai, Delhi, Bengaluru still dominate with over 60% of spending.
The real acceleration, the real story of penetration is happening in the mid-sized cities.
Unquestionably. The fastest growths are in Tier 2 and Tier 3 cities, places like Ludhiana, Agra, Coimbatore.
And its explosive growth.
Since pre-COVID, these non-metro centers have seen a 4-time surge in spending. It absolutely dwarfs the 1.5x growth we saw in Tier 1.
4 times, wow. So spending in non-metros has jumped 175% since 2019. It's a true democratization of credit.
It is, and it's the younger generation that's leading the charge.
Gen Z and millennials, they're adopting credit much earlier. What's driving them?
It's an interesting split. You have about 39% who are driven by immediate gratification, the buy now impulse.
Sure.
But a slightly larger group, 43%, are motivated by long-term financial flexibility, by planning.
And building a credit score early.
Crucially, yes. They see the card as more than just a spending tool. It's a financial planning instrument.
Which makes a lot of sense. No, if you want a mortgage or a car loan later on, you need that formal credit history.
And we see that split in how they spend too. UPI is for the everyday stuff, the essentials.
But the card, the physical card, steps in for the big ticket items, purchases over, say, 1,000 rupees, electronics, furniture.
It creates this perfect complementarity. The card is for investing in your life, while the UPI link keeps that card top of wallet for daily use.
Okay, well, let's pivot now to the regulator because all this rapid, low-ticket, unsecured growth created the exact conditions the RBI was worried about.
It did. The RBI was focused on the stress in these unsecured portfolios, particularly the ones linked to fintech partners, who often target customers who are new to credit.
Right?
And while the overall system is stable, some of the stress metrics started climbing very sharply, specifically loans that are 180 or more days past due.
So the customer hasn't paid in 6 months. This is basically a loss.
It's considered a loss, yes. That number climbed to a really worrying 8.6% in June 2025. That was up from 7.1% just a year before.
So 180 plus days passed. Due or DPD is the full-blown disaster scenario.
Right.
Any other early warning signs?
Yes. If you look at the 31 to 90 DPD bucket, so payments delayed by 1 to 3 months.
Yeah.
For small ticket loans under 10,000 rupees, the delinquency rate hit 4.1% for fintech-linked lending. The regulators saw the risk piling up in these new low-value, high-volume segments. So, RBI wielded the regulatory hammer.
The most consequential move was to increase the capital requirement for banks.
Yes. RBI raised the risk weight for bank credit card loans from 125% up to a substantially higher 150%.
Okay, so for you listening, this is the key step. 150% risk weight means for every 100 rupees loaned out on a credit card, the bank now has to set aside 15 rupees in capital.
Which just immediately makes unsecured lending less profitable forcing banks to be more selecting in their lending.
It puts an immediate premium on what they call return on risk weighted assets.
Yep,
They have to chase higher quality customers to justify putting up that capital.
exactly.
Beyond the risk side, the RBI also stepped in pretty heavily on consumer protection.
Yes, to stop people from falling into those debt traps.
And the big one there was about the minimum payment due, right?
Yeah, this is a huge win for the consumer. The MPD, that's the minimum you have to pay to avoid default. It used to be as low as 2% at some banks. Now it's 5% of the outstanding balance plus all fees.
So, what does that 3% jump really mean for a user?
It means you reduce your loan much faster. Let's say you have a 50,000 rupee balance. A 2% MPD is only 1,000 rupees. A 5% MPD forces you to pay 2,500 loan. So you get out of that high interest cycle quicker. It's true regulatory behavioral engineering.
What about on the security and transparency front?
Transparency is now mandatory. Issuers must give you detailed transaction breakdowns within 24 hours. Security also got a huge upgrade with mandatory two-factor authentication for online transactions over 5,000 rupees.
And the big one for consumers, card on file tokenization.
It means merchants can't store your raw card details anymore, which reduces the risk from data breaches.
And they gave users a little bit of a safety net for late payments.
They did. A 3-day grace period. Banks can't report you to the credit bureaus until after those 3 days. It protects your score from a minor slip-up.
So let's look at the competitive landscape operating under these new tougher rules.
It's still dominated by a few big players. HDFC, the leader, has 22% share. SBI has 19% towards a 20%, then ICICI and Axis.
And HDFC seems to be the one to watch. They're still leading in new card additions.
They added 2.41 lakh cards in August 2024 alone and are enjoying 13% year-on-year growth. They seem to be weathering the changes well.
Probably by focusing on more premium segments that can justify that higher capital cost.
Okay, but we have to talk about Kotak Mahindra Bank here. It's a perfect case study of regulatory power.
Right? It saw its number of cards decline in August 2024.
It lost over 61,000 cards. And that was because RBI banned Kotak from issuing new cards due to technological deficiencies.
And that ban was only lifted in February 2025. Presumably, this created pent-up demand soaked up by HDFC and ICC.
Probably. While Kotak was forced to stop and pour money into tech upgrades, their competitors grabbed their market share. So now, Kotak is playing catch-up.
It highlights the consequences of sloppy regulatory compliance.
The path forward for all lenders seems pretty clear now. Focus on premium customers and better risk scoring.
It's all about maximizing the return on that expensive 150% RWA.
Which means we'll see a big push towards high net worth individuals, where the fees and balances make the capital worth it. And we'll see huge investment in AI and machine learning to fine-tune underwriting.
Especially for those tier 2 and tier 3 cities where traditional data might be a bit thin.
They need AI to score risk accurately there.
So, does all this heavy regulation mean the end of that incredible growth trajectory?
The consensus is no, but it will ensure the growth is more sustainable. PwC still projects transaction volume will grow around 16% year-on-year.
And the RBI itself thinks the average number of cards per user will go from 1.5 today to 2.5 by 2026.
So the growth will continue, but the quality of the lending and the capital backing it will be significantly higher.
Which brings us full circle. We've seen this explosive growth fueled by digital and UPI. We've seen the shifts in geography and demographics.
And we've seen the robust regulatory guardrails that's been built around it to enforce stability.
The story of Indian credit is now really a high-stakes negotiation between inclusion and commercial viability in a market where capital is suddenly very expensive.
That's a perfect way to put it.
So here's the final challenge, the final thought for you to consider. If UPI microtransactions are driving 40% of the volume growth and the regulatory risk weight has jacked up the cost of capital to 150%, what does that mean for consumers like you on the demand side?
On the supply side, How can banks achieve profitability in this high-volume, low-value consumer scape? The pressure is on banks to evolve their business models way beyond just traditional interest income.
They have to rely on interchange fees, hyper efficient operations, and cross selling things like insurance or investments.
Just to make those tiny UPI swipes worth the capital they now have to hold.
It's going to require a level of ingenuity and digital precision that, frankly, very few markets globally have achieved yet. That balance between scale and sustainability is what will define the next decade.
Thank you for watching. Please subscribe, like, comment, and share this podcast with friends and family. Till next time.